James Demmert, I think he's with us here this morning, founder and chief investment officer at Main Street Research. There he is at the New York Stock Exchange. Did you fly in this morning, James?
I did, on a rocket.
This market's taking a rocket south. What do you think?
You know, I think that this is driven by fear and a lot of uncertainty, but what we got yesterday was certainty. That's what we really need. We need to know what this is, what these tariffs will be, and how it's going to impact different sectors in the market. I think it's interesting, the market's sort of trading down to the lows, a little lower in some areas, but kind of where we were last week. And I think that says that we may be flushing this out. I know that may seem unusual, but PEs have been compressed, and particularly in technology and many companies, they're used to, if they know what rules to play by, adapting to them and trying to keep their margins. And that's what this is really about. How can they keep their margins with tariffs coming from left, right, and center? The numbers, James, do you think they were too high? They were too sweeping? I mean, we had heard possibilities of 25% across the board. Do you think this exceeds what was priced in for the worst? In some areas, yes. However, our view has always been that the tariffs are used as a negotiating tool, and let the games begin. Trump is the deal maker. He loves to negotiate deals, I think, better than he likes to do much anything else. And I think there's going to be a lot of negotiating going from here. So I would suggest that investors look at this. This is worst case scenario here. I think from here, we get a better version across the board in most cases on these tariffs, which I think the market would probably invite as good news. And then of course, we have earnings, which we can talk about coming up next week.
James, you have a cool book called Wall Street Lessons. I think it's a fun kind of personal look at the things you've learned from the market from a sort of qualitative standpoint and your experience and what you've seen. And one of those messages that you talk about a lot is don't beat yourself, basically. Don't become your own worst enemy. My colleague Kevin Hanks, a seasoned trader, kind of sent the same message this morning, which is, keep your head and try to think big picture. What do you think keeping a cool head means right now?
Thank you so much for that comment. And
sure.
We think it's extremely important. The human mind's not great at this. Fear creates all kinds of bad decision making, as my book suggests. And here's where you really want to look at, is the bull market still intact? The answer to that is yes. Is AI and tailwinds still driving it? Yes. Is the tariff situation a bump in the road? Absolutely. But be specific as an investor. What is my stock's earnings power, even with tariffs? Maybe there's a bit of a discount. And where is it priced now? And I think when you do that and you look at where stocks are after a 10, 12, 14% decline, you see that in many cases, growth rates are higher than PEs. We haven't seen that, gosh, probably for 18 months, which is a window of opportunity. So that's where I would just have investors get away from the emotional part, get clear on metrics, and hold your stocks here. Don't be a seller. And if you have extra cash, I would use this dip as a great opportunity.
What type of timeline do you think you need to have, James? Do you think these folks who are certain we're going to bear market recession, this is the year, you think they're off?
Yeah, I think they're way off. I think that we're entering the third year of this business cycle. And I don't think the administration wants a bear market or a recession. And I think the Fed is ready to go if they need to lower rates. So I think that those fears people really should put to the side. Use stop losses lower just to mitigate maybe that risk. But I would suggest here, put those fears away. This economy is very resilient. The Fed just said so a couple weeks ago. And even with the tariffs, tariffs are not new news. We've known about these for a quarter or so. So we think that this market it's a bump in the road. The economy will be just fine.
All right. I hate to sound like this guy because this was never really me, but I've become more open to some of these theories that higher rates are constrictive in a way that actually can be inflationary. And so the notion that the Fed could cut brings up it seems they are ready. So to that point, I think that kind of gets lost a little bit, and that should at least have some ability to slow some of this, tourniquet some of the bleeding. James, thanks a lot. Appreciate your thoughts.
Pleasure.
Appreciate your contributions here on the network over the years. James Demmert, founder and chief investment officer at Main Street Research, always there when you need him. Tom, tell me your trades. What you got here? What do you like?
Apple. We're looking at Apple, and it's got the most exposure, right? Because, they parsed out a bunch of their manufacturing to India, Malaysia, Thailand, some of these other countries that are getting tariffs slapped on them at pretty substantial rates at this point. And it's still rich on a valuation basis compared to its historicals. Its super cycle never materialized. AI is still not there yet for Apple. So it's still pretty rich on a valuation basis. So I looked at something, this could be used as a hedge if you're long the stock, and a lot of people are in their 401ks and retirement accounts and trading accounts. Or you could just speculate to the downside if you think there's possibly more pain for Apple. So I looked at a bearish put vertical here where I'm going to go out to the April 17th monthly cycle. So just really short-term positioning, 14 days in this position. Buy the 205 strike put. That's basically at the money, slightly in the money. And then against it, to offset some of the costs, sell the 190 put. So bearish $15 wide put vertical to the downside. You're going to pay anywhere from $4 to $5 for this, depending.
You're fading James.
Yeah.
You're fading James.
Well, I'm fading maybe Apple because
you're inside, he's out. That's inside out.
It's still, yeah, exactly.
Right? First time we've ever said the name of this segment, possibly.
Yeah, it's still.
That's why it's called Inside Out, by the way.
Yes, that's
in case
right.
Anybody knew.
He's inside.
You're inside.
I'm outside.
And then our guest is outside. So I don't know if anybody ever figured that out. It's been one of our more nuanced, complex parts of this program.
And James is probably inside.
Though this bearish trade, I'm going to send you to the outside, Tom.
That's fine. That's fine. James is on the inside. But yeah, if you pay a $4 to $5 debit for this thing, that's what your risk is. It can expand to $15 if it goes below 190. The break even, if you pay roughly about a $4.80 debit for this, that break even is going to be just above $200 a share on this one. That's only about 2% below the current share price. So you don't need a monster move to the downside. Like I said, you can use this as speculation over the next couple of weeks or a hedge against your long stock position.
All right. What else you got? You got one more?
Nvidia. A little bit more constructive on this one because it has been beaten up, down over 32% from those all-time highs. So I looked at taking advantage of the higher implied volatility on this one. If you want to own these shares, but you're still nervous about what's going on in the market with this stock trading about, 105 now? It's kind of bounced off of its lows. I looked at selling a cash secured put in here, going out to April 25th. You're not going to have an earnings event. It gives you a duration of about 3 weeks. In this position. Just sell the 100 put. You're going to collect a credit of just over $3 on that. That's what you can make on this trade. Or if the stock continues to fall, goes below 100, hey, you're comfortable owning the shares at that 100 strike minus the credit you collected of about 320 down to 96.80. So you have that cushion of about 7-8% to the downside below the current share price in there. So taking advantage of higher implied volatility if you want to get into the stock, or just keep that high option premium that you collect on this cash secured put.
All right. Okay. So a little bit more optimistic there with the Nvidia trade.
Yep.
All right. Thanks for the trades, Tom.